If you're over 50, earning good money, and putting extra into your 401k, the government just quietly changed your deal this year. Those extra dollars are Roth only now. No deductions. Most people found out from a slightly smaller paycheck and assumed it was a payroll error. It wasn't. And if your plan doesn't offer a Roth option, it's worse than a smaller paycheck, you can lose the catch-up entirely. I call it the Roth catch-up surprise. And today, I'll show you who's affected, what it actually costs you, and why the smartest women I work with are treating it as an opening instead of a penalty. Hey, welcome back to Align Your Retirement. I'm Hazel Secco, CFP and CDFA, founder of Align Financial Solutions. I call this the Roth catch-up surprise because that's how it's arriving, as a surprise, buried in paycheck fine print. Here's the rule, plainly. Since 2001, anyone 50 or older has been allowed to put extra money into their 401k above the normal limit, the catch-up contribution. For 2026, the normal employee limit is $24,500 and the catch-up is another $8,000 on top. And if you're 60 to 63, there's an even bigger catch-up, $11,250 thanks to a separate Secure 2.0 change. What changed on January 1st is which side of the 401k those catch-up dollars can land on. If your Social Security wages from your employer last year, 2025, were over $150,000, your catch-up contributions must now be Roth after tax. The base, $24,500, still your choice, pre-tax or Roth. It's only the catch-up layer that flipped. 3 details that matter. First, the test is wages from that specific employer, not household income, not investment income, not your joint tax return. Second, if you change jobs, you get a reset. No prior year wages with a new employer means the rule doesn't apply to you there yet. Third, and this is the one almost nobody flags, if your employer's plan doesn't offer a Roth option at all, you don't get to keep making pre-tax catch-ups. You lose the catch-up entirely until they add one. That's worth an email to HR this week. So what does it actually cost? Take the $8,000 catch-up at a 35% marginal rate. Pre-tax, that contribution used to knock about $2,800 off your federal bill. Now you pay that tax up front. That's the real honest cost of this rule, roughly $2,800 a year at 35%. More at 37, less at 32 on the catch-up layer only. Now, that number is what it cost you this year. What almost no one is talking about is what those same dollars are worth later. That's where this stops being a penalty story. Move 1. Figure out if the rule actually catches you and put a number on it. 10 minutes. Step 1. Pull your 2025 W-2 and look at box 3, Social Security wages. Is it over $150,000? The rule applies to you at that employer in 2026. At or under, you keep the pre-tax choice. Nothing changes for you this year, though the threshold gets retested every year. Step 2. Check your plan portal. Some employers now automatically route your catch-up dollars into Roth for you. The rules allow what's called a deemed Roth election. Others just stop your catch-up when you hit the base limit and wait for you to opt in. If you're in the second group and you don't act, you could quietly leave the entire $8,000 uncontributed this year. Look at your election right now. Is your catch-up set to Roth or set to nothing? Step 3. Size the tax change. Multiply your catch-up amount by your marginal rate. That's a deduction you're not getting anymore. If you're maxing the full $8,000 at 35%, plan for roughly $2,800 more in federal tax than last year, all else equal. It's July. There's time to adjust your withholding or estimate so this doesn't become an April surprise stacked on top of everything else. Here's a hypothetical composite. A 58-year-old senior director at a pharmaceutical company, wages around $320,000, portfolio about $2.4 million, planning to step away at 65. Her payroll flipped her catch-up to Roth in January. She found out when her February paycheck came in slightly lighter and assumed it was a benefits error. It wasn't an error. 10 minutes with her elections and a mid-year withholding tweak, the surprise was fully handled by March. The rule cost her about $2,800 in current year tax. What she almost missed is what we cover in Move 2. Because here's the question the headlines never ask. Was that pre-tax deduction actually doing your future self any favors? Quick note before we keep going. This rule is one piece of a much bigger picture, and I put that whole picture into a free guide, the Executive Women's Tax Playbook. 7 moves to make before retirement, the conversion window, the widow's penalty, the stealth taxes like IRMAA, that this catch-up change feeds right into. If today caught your attention, that's where it all connects. Links below, and I'll be there when you finish. Move 2 is the reframe, and it's the heart of this episode. Most women I meet in their 50s have retirement savings that are overwhelmingly pre-tax. Decades of doing the responsible thing, maxing the 401k, taking the deduction, built a 7-figure balance that has a silent business partner, the IRS. Every dollar that comes out in retirement is taxed as ordinary income, and at 73 or 75, required minimum distributions start pulling money out whether you need it or not, pushing up your taxable income, your Medicare premiums through IRMAA, and the tax on your Social Security. That's the picture this rule interrupts. Roth dollars behave completely different in retirement. Qualified withdrawals are tax-free. Roth 401k balances have no required distributions. Roth withdrawals don't inflate the income number that Medicare uses to set your premiums. And if the money passes to your kids, they inherited income tax-free instead of inheriting your tax bill. So yes, the government took away a $2,800 deduction, but it may have handed you something your plan was missing. A forced, automatic, every paycheck built towards tax diversification. 3 buckets: pre-tax, Roth, taxable, instead of one giant pre-tax bucket. That's what gives you choices about your tax bill in retirement instead of a schedule someone else wrote. And notice the timing question hiding underneath. Is paying 35% today actually worse than what you'd pay later? Sometimes, honestly, yes. And if you retire early, the conversion window we covered in the last episode may let you move money at lower rates than your paycheck ever could. But if you're looking at large RMDs, IRMAA cliffs, for married couples, the possibility of one spouse eventually filing single at compressed buckets later is often not the bargain it looks like. This is exactly why lifetime tax planning beats 1-year tax thinking. Composite example, a 61-year-old technology executive, about $2.8 million saved, roughly 90% of it pre-tax, retiring at 67. Her projection showed RMDs in her late 70s large enough to push her 2 IRMAA tiers up. For her, the mandatory Roth catch-up at her age, the bigger $11,250 super catch-up, plus a series of planned conversion years after retirement, meaningfully flattened that future income spike. The rule she was annoyed about in January became the first break in the strategy. So the rule is live. You know if you're caught, and you know what Roth dollars are actually for. Move 3 is what to do about it before December, because 2 of these levers close at year-end. And if you're sitting there wondering what this looks like for your bucket specifically, that's the kind of thing I do on a short call. Links below whenever you want it. Now let's keep going. Move 3. Fold this into an actual mid-year plan. First, you're also losing a deduction you had last year. So if you have RSUs or a bonus stacked on top, your withholding can fall short. Second, this mandatory Roth catch-up while you're still working is the same tax diversification strategy as a Roth conversion window we covered last episode, just at a different life stage. If retirement is inside 10 years, plan them together on one timeline, not one December at a time. So let me pull it together. The Roth catch-up surprise is real. If your wages were over $150,000 last year, your 401k catch-up is Roth now. You're allowed to be annoyed about it. I probably would be too, but handled on purpose, it's 10 minutes of admin. Check your W-2, flip your election, adjust your withholding, and a push towards the one thing your retirement tax picture was probably missing. Money the IRS has no claim on, no schedule for, and no say over. The deduction was this year's story. The tax-free bucket is the next 30-year story. If you want the whole map this rule sits on, the Executive Women's Tax Playbook is linked below. Start there. And if you'd rather look at your own numbers with someone, there's a link below to book a complimentary 15-minute call. No pitch, no product sales either. I'm a fee-only fiduciary, so whether we work together or not, you'll walk away with clarity on your best next step. Now, if you want the other half of this strategy, the conversion window that opens the day you stop working, watch this one next. It's the piece that pairs with everything we just covered, and it's the move the smartest women I work with plan years ahead of time. Hazel Secco, CFP, and CDFA, retirement is too important to wing. I'll see you in the next video.